All right, welcome everybody to the first of two classes. The idea behind this class is that, as I've been a CPA for 29 years, I think it's been 29, gosh, seems like a long time. I started when I was 9 years old. And there are certain recurring questions that clients typically have, big questions that there's a ton of misunderstanding on. And I thought it'd be nice just to put together a class which I think most people that have some financial considerations during their lifetime, you might have some aha moments, things that I didn't know that, things that, wow, I wish I'd known that, or I could use that in the future, and kind of get you prepared for those kinds of things as they come up. So it's kind of 29 years of being in the business, and I thought I'd just kind of bring a lot of that into one meeting, so you don't have to pay me for an hour of my time every time you have one of those questions. I don't know if that was such a great idea of mine, but we'll go from there. My name is Brian Evans, for those of you that don't know, and I have Bauer Evans CPAs, the founders back here, Bob Bauer. Thanks for coming, Bob. It's tough to get him out of the office at nighttime, so I appreciate him coming. And I went to work for Bob, it was 22 years ago. He was the sole proprietor. It was a real easy interview. He had about 30 stacks of files in his office, and I had a pulse. So he hired me, even though I was a Coug, and he's a Husky. And we just kind of took off from there. 19 years ago, I bought half the firm, and then just continued on from there. We grew the firm, and now I think it's the second biggest CPA firm in Everett. We've expanded. Mr. Rumsey here, his practice merged into ours in Marysville, and we also have a practice up in Bellevue. Michelle's a representative of that here, and bringing in other practices too. Bet you didn't know that, George. We're up to about 4,000 clients on the CPA side, and so that's going well. So I have a lot of experience going through all of that whole thing to share with you today. Also, in 1999, Bob and I founded Bond Street Wealth Management, a full financial planning firm. So I started getting out of the daily CPA side of things and into this because it allowed me to combine all my training in the tax department, but along with investing, insurance, estate, trusts, all the things that go into the whole big picture financial planning. So I got to do a lot more with that than I was going to do as just a CPA only. Company number 3, that was a kind of an interesting story. I launched 3 exchange-traded funds on the New York Stock Exchange. One morning I had a download, and we just I call it a download from God, because I just my head was full of all these ideas about how to build a better index. I felt pretty strongly about it, and so launching your own funds on the New York Stock Exchange is not easy to do. I can just tell you that. But I have great staff, so with their help, we were able to put 3 smart indexes on the market to compete with the S&P 500 and other indexes that were better in that they're valuation based. I won't get into the details of those, but one of the interesting things I got to do, and trust me, as a accounting student at Wazoo, I didn't think I'd be ringing the bell someday on the New York Stock Exchange. But got to do that in January of last year. It was quite the week. My family was there, my little kids were there in their little suits and ties on the floor of the exchange, and after a week of Statue of Liberty, and I got to do that. We had the big reception at One Wall Street overlooking Ground Zero, and the big reception in their boardroom, and these fancy dinners, and the day after this was the first time I got to go on TV, and of course it was live, national Fox Business. I didn't get to work my way up, and my kids just thought that's how we roll. We go to New York, take over the city, Dad's on TV, whoop-de-doo. I want to go back to Toys R Us, It was kind of an interesting week, but hopefully they'll appreciate that someday. But so that was a pretty exciting time. We're about a little over 2 years into the ETFs, and so that's another area I've got to venture into. And you guys thought being an accountant was boring. It's not. What will we be covering today? Well, in the first class today, as you can see, and you all have handouts, workbooks. They're going to be similar to my slides. So most of the stuff on here that we thought was important is in your workbook. They're not going to be exactly tracking, but they'll be a good reference for you as we get into it. But here's some things. Family mission statement is one thing that several people at the firm, including Michelle, helped work on. We'll talk about that. Important documents you need, how to prepare to be an executor. A lot of people that are in charge of finances, probably a lot of people that attend a seminar like this, maybe are going to be executors someday. And we're going to talk about how to prepare for that. Final arrangements, how to keep the peace. I'm sure we all have a horror story or somebody that we know that didn't have a good experience when somebody passed away on the financial part of it. We're going to talk about trusts, U.S. equity markets, global bond markets, international equities, broker-dealers versus registered investment advisors. I'm going to go over annuities, explain them, and particularly equity index annuities. So the first part I want to get into is family mission statement. As a business, I'm always told, you know, we should have a business mission statement, and we do. But I think that, you know, the world and your life is more about how much money you end up with. I don't look at my clients and say, gee, you're a success because you have 2 extra zeros after your statement account balance than this other person. It's not about that. So I think it's good before we start launching into tax savings and investing and all these strategies to have more zeros on the end of our statement. Maybe we ought to start out with what's really important. So I think one thing that we like to talk to people about is defining your mission and values and write them down. And so we have in your workbooks probably a little something there, but what we've done for some people there is to help them along with some questions that they can consider. I know I did this with my own family. You know, what are our family attributes? You know, even with my boys and everything, what's important to us? I mean, one thing we do is we persevere. You know, there are different things that different people would find important. But defining that, obviously, I think, especially as we get older, we understand how important knowing what your goals are, what you're trying to accomplish, who you are, and putting them down. We'll even help you. If you guys want to fill this out, we'd be happy to print these out on some really neat paper, frame them, and give them to you. We don't charge for that. I got some cheap frames at Molback, or whatever, Michael's, I guess it was. So they're really nice looking, though. But I put one on our wall in our house. When you walk in, you can read our family mission statement. Important documents. Obviously, I don't expect you to be able to read this. I can't even read it with my glasses. But this is a good step to go through. I see most of you have a life and legacy planner that we put together and gave you here. There's various pages in it. But one of the most important pages is this. To not only identify whether or not you have particular documents, but to put the location down. And let me give you some examples. I know most of the people, they get about 6 or 7 into this and they go, oops, I suppose I need to do a will or something basic like that, or a health care directive. Gee, I don't think I have one. More commonly, I'll say, do you have a will? I always ask people, do you have a will? And they'll say, you know, once in a while, they'll say, yeah, I have a will. Can I see it? And it's kind of yellow and crinkly, and I might open it up. And well, I remember you talking about your grandkids, but I don't even see your kids listed in here, and it was written before they had their own kids. You know, it's so long ago, I don't think it's very valid anymore. So this will be kind of a tweak to say, all right, maybe it's time I look at some of these things just to make sure I have them. There's things on here, some things you won't need, you know, mortgage papers so much, loan documents, but safe deposit box key, where is it? I mean, if I'm going to be executor for someone, I would like to know where this stuff is. I know that, my wife doesn't know where half this stuff is. I have to write it down, so if something happened to me. Another example I would share with you, I was asking my dad, because I was filling out his will for him, because he never had one. He wasn't going to, so I had to do it for him. I asked him, do you have life insurance? He said, yeah, I got life insurance. And I said, great, okay. How much is it? He said, I don't know. I said, well, who's it with? He said, I don't know. I said, where's the policy? I don't know. Well, let me share with you. My dad has a 2,700 square foot house, and every inch of it's full. He has a 9-car barn that's full with a second story that's full. Another barn next to it that's full. And that wasn't enough, so he built a 4-car carport with storage over that's full. He hasn't thrown out anything in 78 years. I don't know where that would be. It would take a lifetime to uncover that. So these are the kinds of questions you're going to want to address and figure out how you're doing on those. How do I prepare to be executor? Again, I got news for everybody here. We're all going to die someday. We're all going to know people that die someday. Sometimes we're going to be asked to be executor. Maybe we have. I imagine there's a number of you that have. I know I'm going to be executor for a lot of people. I'm going to want to be prepared. So I'm going to need to follow my own advice here and make sure that I have some of these things answered, because there's been a lot of what we deal with, through the CPA firm or through an attorney's office, is problems related to not preparing for this. And so I think it's really important. So let's talk about some of the details on how we would do that. As I mentioned, no one wants to think about their final arrangements. I mean, sometimes going to your CPA or estate planner is kind of like going to the dentist. Let's see, we're going to talk about your taxes, maybe your estate planning, some of these really tough issues, final arrangements, legacy planning, all this stuff, when you die, when she dies, who dies first, all this stuff. It's not very much fun to talk about. But I think it's inevitable just that we are prepared and have that peace of mind. And one of the things that I share with people on one of the pushbacks, I know Bob can agree with this, is that they say, well, I don't care what happens to my money. They'll have plenty. I don't really care. I said, well, that may be, but you want it to go to your kids or charity, right? Yeah. I said, well, if you don't do a couple simple estate planning techniques here, you're going to lose maybe $1 million to the federal government. And that ought to cover about maybe, 3 seconds on the interest on the national debt. So let's count out your life. 1, 2, 3. There you go. That was your life. 3 seconds of interest on the national debt. How do you feel now? And they're like, not very good. So do you want to do some planning so it goes to where you want it to go? And they're like, yeah. So it's something to consider as you look at that. As I thought about, when I'm going to be executor for somebody that I'm going to have to deal with, I would like to know before they pass away how they'd like to be memorialized, whether they want organ donations. These are really difficult questions to deal with or to ask. Obviously, you can't ask after they passed away. Very difficult questions to deal with in the grieving process, and some of these have to be answered right away. Do you have a burial plot? Wouldn't it be nice if you're executor to know if somebody has a burial plot? You're not going to move them later. Oops, we cremated them. I didn't know. It's kind of a touchy subject, but really important that we get that stuff addressed before. So a very simple thing. We got some pages in here. You can copy them, or they're in your life and legacy planner there. You can just copy off a couple pertinent pages to someone that you're going to be executor for, and your spouse, for instance, perhaps. Make sure those couple of pages are filled out. What else might you want? Just knowing, having that conversation about, favorite Bible passage, readings, music, just different things. Again, pretty tough to have to figure this out when you're put in that situation. The real interesting stuff comes after that and gets into the part where settling an estate. And let me give you an example. I've got so many, but one example, 2 brothers and a sister, one mom. The 2 brothers lived with mom right into their 60s. She passed away, very simple will. We're going to split everything 3 ways. Okay. So 7 years after she passed away and multiple lawsuits, it finally ended up with Bob and I to figure out in our CPA firm. And I remember, it's 3 kids, split everything 3 ways. I don't get it. What's the problem? Why 7 years and all this wasted money? And by this time, this close family just hated each other. Well, we had things like a new marriage, and she wanted stuff that maybe she shouldn't want, or hurt feelings, or gee, while you lived with mom, you bought a car that you shouldn't have bought. I want that money back. And it even got to the point, I'm not making this up, they were going to go to court to split up 2 things. One was a cactus plant, and one was photography equipment, obsolete photography equipment. So I couldn't take it anymore, so I suggested a solution. I said, if you'll give me a knife and a hammer, I can solve this. I can cut a cactus plant into 3 pieces. I can break some lenses into equal shattered pieces of glass for 3. It was unreal. Got to the point where the transfer of the plant had to be done in such a way that they would not cross paths. So I suppose there's a lot of people that know of somebody that's gone through a very poor estate settlement. There are so many examples of people that come into my office. The siblings are not speaking anymore, and they were fine before somebody passed away. It could be something very trivial. It typically is very trivial. It's not the big stuff. The big stuff's easy. Split a brokerage account 3 ways, piece of cake. So how do you get around that? Very simple form we have in the Life and Legacy Planner. Real estate and valuable personal items inventory. Simply description of the pieces and who gets them. This should be part of your will. So let me do another, for instance, one that I did. I said, Dad, there's 3 boys. There's one 65 cherry red GTO convertible. I am not taking a saw to that. Who gets it? Little brother? Perfect. Put his name down. Dad, there's only one. Then we got to those kinds of things. We got to, his Hall of Fame ring as a baseball coach. There's only one of those. There's 3 of us. I said, okay, you get that because you bought it for me originally. And someone else gets another memorabilia, someone else. So those memorabilia things, those are usually the ones that are fought over. So he thought it through and made sure that things were as he wished. Then I did the important thing. I communicated that to my brothers. I said, this is what's coming. Everybody says, oh, we'll be fine. And I just caught myself almost saying that. But how many times have I seen the, oh, we'll be fine, and it's not so fine 2 years later? So it was nice just to communicate that. And my older brother had an aha moment. He thought he was getting the house. No, he got the opportunity to live in the house. He still owed my little brother if he took over the house for his 3rd. He was like, huh? I do? Yeah, and you'd owe me a 3rd too. Really? I'm like, yeah. Oh, okay. That could have been a big problem afterwards unless that was dealt with beforehand. So you may have situations like that. Vacation homes are a real bugaboo, especially vacation home. One sibling lives here, an hour away. One sibling lives in Alabama. The one in Alabama wants to sell it. Now what? Well, I think we got a problem. That wasn't addressed. These things should be addressed beforehand so that you don't set your family up for disaster later as part of your legacy plan. It's not that hard to fill this stuff out, but it's really important, again, to focus on the irreplaceables. The rings, the mementos, the pictures, the antique cars, or the, whatever it is. You've got to focus on those, because that's where really most of the issue is. It's not going to be on the big 401k plan assets and those kinds of things. How do I reduce the amount of federal, estate, and gift tax I have to pay? We're going to kind of summarize that because there's a lot of misconceptions about estate and gift tax. And the first thing I want to get into is something that I'd say 95% of people coming in the office don't truly understand. So we're going to take a stab at this. And don't feel bad if you don't get all the concepts the first time. We're going to go through about 2 years of business school and 2 classes. I'm going to use lots of examples. I'm going to, the slides I think are helpful. I don't expect you to retain everything here and be able to teach this next time. Well, except for the couple people in the back, but who someday will. But I'm hoping that by the use of the examples, it's a little stickier. I know that between the visual and the stories and the explanation in the paper, that between the different methodologies, it may stick. Or at least it will identify a question that you want looked into more. Step up in basis. What in the world is step up in basis? Well, first off, we're going to differentiate the country between community property states and common law states. The ones in the red are community property states. We get an advantage when it comes to step up in basis over the gray states. There's 9 community property states, I believe it is. So let me give you an example. Let's say that husband and wife, we bought a piece of land 20 years ago for $100,000, and now it's worth $1 million. If we sell it, we have a $900,000 gain. We will pay tax on that gain. If we sell it, if it's sold the day after one of us passes away, we got essentially a double step up. Both of our halves, our ownership in that lands had a step up, which means it's as if we bought it on the date of the first death at its fair market value. So forget that we paid $100,000 for it. It doesn't matter anymore. It's worth $1 million at the date of death. That's its new basis. When we sell that for $1 million, there's no gain. So one of the examples I had there was, had a husband and wife. He really liked buying rental houses, and he liked the most inexpensive beater fixer-uppers. So he had 20 of them, and he passed away. And the poor wife, she was just, oh my gosh, what am I going to do? We bought these all, 30 years ago. There's no cost basis. We've depreciated them. I'll have this huge tax bill. I don't want a bunch of fixer-up rentals. I don't know how to do that. So I said, well, let me tell you about step up in basis. There's no tax, no income tax when you sell any of these. You got a full step up. She was so relieved that she wasn't going to have to carry these rental houses. Is that pretty clear? Just basic step up. There's a couple of assets that don't receive the step up in basis. That would include any retirement accounts. Someone is going to pay tax on them someday. And any gains within annuities is another one. That full step up does not necessarily occur in these gray states. You'd only get a half step up. Only one person passed away. In a community property state, the marital community is like one person. In the common law state, it's more like 2 different entities. And so they get a half step up, whereas a surviving spouse wouldn't receive that step up in basis. So it does depend on where the assets are. Another issue that can come up related to that is very often after the fact I've heard someone say, hey, we did some estate planning. I'm like, oh no. Yeah, what'd you do? Well, we gifted mom's house to the kids to avoid probate. Pretty smart, huh? Save a couple grand in attorney's fees that way. I'm like, well, with a gift, you also gift the cost basis. So when, in this example, let's say the house was purchased for 100 grand way back when. It's worth $1 million now. And the dad passed away maybe 20 years ago when it was worth 200. So that would have been its cost basis at the date of her death. But they gifted it, so the gift basis goes with the property. So if it was done before mom passed away, the new basis is still $200,000. The kids are going to sell that and have an $800,000 taxable gain they could have avoided had they not done the gift right before she died. So it's not always the best idea to do your own estate planning because there's other things that may come into play that you didn't think about. And frankly, probate in the state of Washington is not a big deal. The attorneys don't charge all that much. It's an hourly rate in this state. Totally different in California. It's a percentage of the estate. So there's certain states where you're going to want to have living trusts for sure. Washington isn't necessarily one of those states. Wills generally are just fine in this state. Let's talk about inherited IRAs. I mentioned that most assets receive a step-up in basis. IRAs do not. Surviving spouses, however, have extra options of rolling it into their own IRAs, and others, let's say it's a son or daughter that inherit it, they generally have to take the income in over 5 years. So let's say that somebody inherited a $300,000 IRA from their parent. I would not suggest that they cash that out all in 1 year. That's going to put them right into the highest tax bracket. They're going to pay 40% on a lot of those dollars. Had they spread that out over 5 years, then the average tax bracket would come down and they'd save tens of thousands of dollars just by spreading it out. You can also elect IRS Section 72T if you're younger and you inherit it from younger than 59 and a half and you inherit it from, say, a parent or a grandparent, then you can spread the distributions over a lifetime. Again, what that does is it allows to just be taxed at your marginal rate instead of popping you up into the highest marginal rate all at once. So there are ways to, a lot of tax planning isn't hocus pocus, it's just spreading your taxable income across different years so that you're taking advantage of all the lowest rates and not having a spike in 1 year and paying an extra marginal rate. So that's a big part of tax planning. This is just one example of that. Let's talk about the inheritance tax. We won't talk long about them because there isn't one. A lot of people think they come in as, I'm inheriting some money, I'm going to get killed on taxes. So we have a discussion. We discuss about the step-up in basis. And they're like, wow, you mean there's no income tax on that? Yeah, but what about that estate tax? I hear that's the nastiest one. Well, it can be. But when somebody passes away, all of their assets are added up. Everything. Brokerage accounts, their personal residence, their cars, their clothes, their everything. It's all added up and there's a number. If that number is below $2 million in the state of Washington, no tax. If it's below $5.25 million for federal purposes, no tax. If it's in between, you'll pay some state tax. But the tax is always paid at the estate level, meaning that the executor is going to accumulate the assets, figure out with their CPA or estate attorney, figure out what the value is. The estate is going to pay any of the estate tax is a tax on the value, not the gains, just the value. They will pay that tax. What's left is distributed. So when it comes in somebody inheriting that, those taxes should have already been paid at the source. There's no inheritance tax to deal with. There can be an estate tax. Any questions about that? A lot of words on this slide. I'll try and explain this. And we're getting into some pretty deep topics here, but we're going to hopefully go steady and not too fast and have some understanding of those. Credit Shelter Trust. I just mentioned how someone can pass away with $2 million in the state of Washington without any estate tax, or $5.25 million federally. But let's say a couple is worth $4 million. Or in one case, I'll give this example. But let's say they're worth $4 million and the husband decides he's going to save some money, because this is a real example I had. So he went to the office supply store, copied off a sample will, filled in the names, and stuck it in his file. So he passed away, and she inherited his assets. Well, in the case where they were worth $4 million, you think, well, that's $2 million each. That should be no estate tax. No. They were worth 4, 2 and 2. When he passed away, his 2 went to her. Now she's at 4. When she passes away, only 2 is excluded from estate tax. The other 2 is going to be taxed. Now at the time of the person I'm talking about, he was actually in the federal estate tax area, and it was a $1 million mistake. There was $1 million of federal estate taxes that could have been avoided with one paragraph in the will called the Credit Shelter Trust. What that does is it says, instead of all my assets going directly to my spouse, they will instead go into a trust for the benefit of my spouse. The spouse will own the income from that trust, and if she needs it, she can have the principal. If she runs out of money, then she can have that too. But being over here in a trust, it is no longer part of her actual estate because it has heirs. There are heirs in the will. Once she passes, it goes to someone else or to a charity or kids or whatever. So this money sitting there, when she passes away, no matter how much it grows to, that event's already happened. It was funded with whatever it was funded with, free of estate tax. It will never be taxed. It will go to the heirs. We look at hers, and then that would be a separate amount. So in a marital community, it's very important, if you're above the, or could be above the $4 million, Credit Shelter Trust. If you're not above it, what do I care? Well, here's something that can happen. One of my fun examples. Let's say the husband and wife, and they're worth, say $1.5 million. So they say, oh, we don't need that. Well, husband passes away, and wife gets the money. Now she has $1.5 million, still no estate tax problem. But then, as she gets older, she meets some guy named Raul, the pool boy. And Raul is suave. Raul likes that money sitting there, that $1.5 million. Raul doesn't make a lot of money as a pool boy. And so she's kind of smitten by Raul. Well, fast forward, the people that are going to get the husband's assets are Raul's kids. Second marriages. So it's a way, and most people, oh, that's never happened. It's like, well, it does, you know. or maybe you know somebody where it might apply to. By having this, half of the assets, if I passed away, my half would go into a trust. And if my wife got remarried, I don't have to worry about that husband taking my principal. The principal is going to Sam and Ben. It's not going somewhere else. It's in a trust. It's separated. So it's the best way to protect assets in a marital community from unexpected events, second marriages, that kind of thing. So that is the Credit Shelter Trust. Gift tax, another area of misconception. A lot of people think, well, gee, I can't give away some money, I'll pay the gift tax. Well, it is called, there's not a separate gift tax, it's a estate and gift tax. What that means is that during your lifetime or at death, you can have $2 million or a combination of giving away $2 million and dying with money up to $2 million. So they're combined. But we have an exclusion. The first $14,000 per person is excluded. So let's say husband and wife, and we have one child, and they're married. And we give them $60,000. Saying, oh, you got a tax, right? No. Gave them $60,000, so really how that splits up is I gave one of them 15 and the other one 15, and my wife gave one 15 and the other 15. Well, 14 of each of those individual gifts is excluded. So I only have a $1,000 taxable gift times 4. Do I pay any tax? No. We take the $2 million I can die with or give away, and we subtract $4,000 from that, and now I can only die with $1,996,000 before I pay a tax. It just starts eating into the $2 million or the 5.25 for federal. So there's a lot of planning that can be done around gifting. So you don't have to consider that. The thing I would consider is what you gift. Don't gift something with a low basis, because then you're gifting the basis too. They're going to pay a big tax on that someday. What if you have mountains of money? Gosh, I can't gift enough away. I got $20 million in net worth and I don't know what to do. Well, that's when I send you to Bob back here, and we talk about some advanced estate planning, including family limited partnerships that, what's that?
Accounting fees are great estate planning.
Accounting fees are great estate planning. The expense to the accountants comes out of your estate, so you're no longer taxed on that. So I would encourage you all to pay a lot of accounting fees. Just kidding. So the family limited partnerships, you can actually, one of the problems with gifting in these situations is, well, I don't mind giving my kids stuff. I just don't want them to make any decisions while I'm alive, because they're a bunch of doofuses. And say, well, we can get around that. You can put a big asset into a limited partnership, a family limited partnership, and start gifting shares. You say, yeah, but what when they own more than 50%? What happens then? Say, well, actually there's going to be 2 categories of shares. There's a general partner share, 1%, and a limited partner share for 99%. You're gifting the limited partner shares. So you can get to a point where you've gifted 99% of that apartment building or whatever was in that trust. And they say, well, hey, Dad, we want our money. We own 99%. Let's take a vote. You say, no problem. Let's take a vote on that. Well, let's gather everybody that has a vote. Oh, that'd be the 1% general partner share. I vote, no way, doofus. Go away. They don't have a vote. Even though they own 99% of the value of the asset, it's out of the estate. So you can maintain control, and you can gift more than $14,000 a year by using more advanced things like lack of liquidity and marketability beyond the scope of this class. Family trusts. Let's talk about that. Let's say that you're just a wonderful person. You have some adorable grandkids. They're so cute. And in your will, you've left, $200,000 apiece to these grandkids so they can have a good start in life. Well, you're well-meaning. Well, let me tell you what happens. If you pass away and they're under 18, it goes into an account, but the day they turn 18, they have access to it. So when they are 18, they have two piles of paper in front of them. This is a bunch of college applications. This is $200,000. They go to the Lamborghini dealership and they say, I'll take the red one and fill it full of beer. You can ruin someone by leaving them a bunch of money that they have at 18. I want you all to think back at what disasters you were at 18 right now. And think about a pile of money or 4 to 8 years of misery in college. Which one are you going to pick? George would have picked the college, I'm sure. Absolutely.
Especially Wazoo.
Especially Wazoo. Thank you. I like him.
You get both there.
So, Bob's a Husky. So it's really important when you're doing your planning that you don't mess up a whole generation of children. I think that's important. I think most of you can see some wisdom in that. How you do that is you put the money into a trust. So, and you put somebody in charge of that trust that will make good decisions based on your wishes. So the $200,000, the kid turns 18, he says, I want my 200 grand. That's mine, right? Well, it's yours, but let's take a vote. Unfortunately, you don't have one. I do. Go to college. I'll pay for your college. I'll pay for your room and board. But I want a Lamborghini. No can do. I'll buy you a Ford. That person can yay or nay every decision related to finances. And in my own will, I have money set aside for all those college and that kinds of things up to a point. And then at 25, they have another access to a little bit more. And at 30, they have the rest. So when they spend it on something in their early years and it's gone, they get another shot. And when it's gone, they got one more. Who should serve as trustee? So we went through this process. We have our list done. I know what happens when I pass away. The taxes are handled. I have a will. It's up to date. I've thought about these trusts. I've mentioned them in the will. You don't have to set these up, by the way. You don't have to spend money on setting up trusts and all that stuff. They're just paragraphs in your will. When I die, then these trusts will be established and these rules will be followed. It's not that complicated. But then, who is trustee? So, an example I have there, I remember this one. He had the will and everything, and I looked at the trustee. I said, "Who's this?" He said, "Well, that's my older brother." I'm looking at this 93-year-old guy and going, "How's your older brother doing?" He says, "Well, he has Alzheimer's." Serious. A little pause. I'm like, "Do you think that's a problem?" Yeah, it is, isn't it? Maybe I should change that. I'm like, yeah, maybe you should change that. It never occurred to him that his brother won't be able to serve as trustee, and there was no secondary trustee listed. We got a problem. Who will be trustee? Someone may be in your will that you wrote some years ago maybe isn't appropriate today. Might want to review that. If you have nobody that you trust to be trustee, you can hire what's called a corporate trustee. In the past, that has been Bank of America, Merrill Lynch, that kind of outfit. I don't see a lot of excitement in the room all of a sudden. Probably shouldn't, because I haven't heard of a lot of good experiences with the big organizations. There are other options. This is a flyer on a company called National Advisors Trust. I am a shareholder in it. I'll mention that. But their trustee fee is a maximum of 0.4% a year. So it's a fraction of what the big guys charge. There are options. Very often these are used as a backup or a second backup. I want my sister, if she can't do it, my daughter, if neither one of them wants to or can, then a catch-all. So they're just the last resort kind of trust. This is a little more advanced topic. So I'll try and, if you don't follow it all, we have an example here, you can read it later. Charitable remainder trust. This is a great tax savings vehicle that people in this room have used. Basically how it works is, let's say that you don't like taxes, you have some asset that you don't really want anymore because it's not really, let's say it's a piece of land somewhere, and all you're doing is paying property taxes on it for the next generation. That's pretty unrewarding. And maybe you have a charitable intent in your legacy plan. Well, I might suggest, let's say that piece of land's worth $500,000. And I say, well, let's talk about this trust. And let me tell you about how it can benefit you. So the first thing we do is we take that piece of land and we put it into a charitable trust. When you do that, you get a deduction, a charitable deduction on Schedule A, your itemized deductions. It's not for $500,000, it's for the actuarially prepared amount based upon your age and so forth. But the IRS will give you a big refund on that year's taxes. That's pretty cool. I only paid $10,000 for that piece of land 40 years ago. What else you got for me, Brian? I'll say, well, now you can sell that asset and you'll pay no income tax on the $490,000 gain. That's pretty cool. What else you got for me, Brian? That $500,000 is no longer part of your estate. You'll pay no state estate tax or federal estate tax. While we're at it, what else you got for me? Well, now we can reinvest the proceeds, all $500K, because there was no tax, into accounts that will pay you a cash flow for life. That cash flow can be set up to about 8%, 8 to 9% for the rest of your life on whatever the value of that account is. So now you turned a non-cash flow producing asset, avoided, you got a charitable deduction, you avoided capital gains, avoided estate tax, and got cash flow for life, and or joint lives if you're married, the second to pass away. The only potential negative here is when the second person passes away, whatever's in that account goes to the charity. That's why I said have a charitable intent when you start this process. So that charity can be changed during the years. So if you want a front row seat at church or something, you might mention that they're in your charitable trust, and if they move you to the back, maybe you can change it to the next church. I don't know, whatever. But the point is that there is a big potential tax savings from an asset that otherwise would have had potentially no positive impact on your life. And this is used a lot of times where people have significant assets. They don't want to just throw a pile of money at the next generation. You know, maybe they've already decided how much is appropriate, but they don't want to just load them up and maybe suck away their incentive. And they have a charitable intent. Any questions on that? There's something called a private charitable foundation. Somebody that has significant assets they want to leave to charity, rather than just they pass away and it just gets distributed. Their legacy can live on through a private charitable foundation where the assets go into this foundation and essentially the earnings every year get distributed to the charities. And the trustees of this foundation might be their children or people they respect, and will determine each year who gets that. And it's kind of a in perpetuity kind of thing. It's really a neat deal. We have a number of clients that have had these in their wills, and they'll be funding a lot of great charities with operating money for years and years to come, and they can count on that. So it's kind of a neat legacy plan.
Could I ask a question?
Yes, question.
When you start giving $14,000 away, do you have to keep track of that?
The question was, when you give $14,000 away, do you have to keep track of that? Absolutely not.
Oh, you don't.
There's no gift tax return. You don't have to. Nope.
Oh, because I've been worrying about that.
Stop worrying. Okay. Stock market valuation. I want to talk about this because I manage $120-something million in the market, and of course I get a lot of people asking me about stocks and saying, hey, I want to buy this, or I should sell that, and I'm always amazed at how they get their information. Because they'll say, I need to buy this stock, and I said, let me guess, your neighbor. No, the garbage man. Okay. I remember one call one day. These are real examples that I'm giving. I'm not making any of these up. You wouldn't believe me if I did. He called and says, yeah, I want to buy this .com. This is, 99. I said, okay, well, let me ask you a couple questions if you don't mind. He said, sure. I said, what do they make? Said, I don't know. I said, okay, you don't know what they make. So I probably shouldn't ask about your research into what they're going to do in the future. Yeah, I don't really know, but they've been going up every day. I said, okay, well, let me look at the stats on them. I said, okay. I said, well, they are worth $4 billion on the stock market today. That was their value on the market. Their gross sales in the last 12 months were $1 million. 1/1000th, or not even that, of the value, 1/4 of 1/1000th. And their expenses were over $20 million to raise $1 million in revenue. I said, tell you what, I know another company that grosses $1 million, that you, instead of paying $4 billion for it, you can have the whole thing for $4 million. He said, really, what's that? I said, Bauer Evans CPA firm, I'll sell it to you tomorrow. He's like, I get your point. So how do we know whether a stock is good, bad, or indifferent? You say, well, if I like the company, it's a good stock, and I'll buy the stock. I say, well, that's a good start, no doubt about it. But let's say I'm buying a car. I like the car. So it's a '68 Camaro convertible, which I used to own. I wish I hadn't sold it. I really want that car, and it's $10,000, and it's primo condition. Well, I'm buying that. It's $30,000. I'm buying it with a gulp. Let's say that same car is $300,000 or $3 million. Well, of course I'm not buying it. Well, you told me you wanted the car. Why should it matter whether it's overpriced or underpriced? Buy the car. Like, I know I said that, but it does matter. Same with stocks. Is it undervalued or is it overvalued? That's what's important. So let's look at how do we measure undervalued, overvalued? Well, I would contend that stocks, you buy a stock, which means you're a shareholder in the company because you think that company is going to earn a lot of profit in the future relative to how much you're having to pay for that share of the profit. Most companies are in business to make a profit eventually. That's kind of why you would invest in them. How do we measure that? It's called the PE ratio. This is the first half. The PE ratio is the price-earnings ratio. It's one of the most important things, and I'm talking about the forward price earnings. What you'll be looking at mostly when you see this is historical. I'm not interested in what they made last year. That's all been assessed and talked about, bannered about on TV. I'm interested in the forward projection of price relative to earnings. So let's say that Company A, I won't follow this example here, but Company A and Company B both trade at $100 a share. Company A makes, $20 profit per share. So every $100 invested, we've got a $20 gain. That would be 100 over 20, or price earnings of 5. You want this number to be low. So that first company again would have $100 share price, $20 of earnings of 5 PE. Well, let's say that they were only going to make $5 of profit. Well, you take the 100 over the $5, that'd be a 20 PE. So you're paying 20 times its annual earnings to buy the stock. With the other example, you're only paying 5 times the annual earnings. That sounds better to me. So when you do that in percentages, well, 5 times earnings is a 20% annual return on the value of your investment. So there's different ways to look at that. Which one would you buy based on that is the question here. There's another factor that's going to go into that on the next slide, but this is really important because if we look back at the crash of 2000, the dot-com crash, the typical NASDAQ stock was trading at 200 times earnings. They were earning 50 cents for every $100 invested, or half of 1%. That's not a very good rate of return. So clearly they were overvalued in retrospect. And had we looked at this, we could have seen that. 5-year forward PEG ratio. That's the real number. So the first step was the PE. Now we're going to add the G, the growth. Because you could have two companies, both $100 a share and $5 of profit per share. They both have a PE of 20. Well, I'm going to contend one could be good and one not so good. Let's say the one at 20 had a growth of earnings projected at 1% a year. Well, it's 20 times now, eventually be 19, and someday down the road maybe 18 times earnings. Remember, we want this number to be lower. The second company is maybe more like an Apple. It's growing its earnings at 30% a year. So it's at 5 times earning, or at 20 times earnings. The next year, 17, 14, 10, 8, 6. If we project 5 years of earnings and then look at it, factoring in the growth rate of earnings, we have a better feel for not only what they're going to make next year, but years to come relative to what you're paying for it. This is called a valuation principle that is, in my mind, the most important principle there can be when analyzing a stock. So the lower the PEG ratio, the better. The historical average has been about 1.6. I have some charts in there that just talk about, a lot of people may have read my newsletters over the last year or two, and I got the question over and over, is the stock market overvalued, undervalued, or indifferent? And you may have, for those of you who read them, which would be maybe a couple people, I hope, that I was saying, actually, I think it's undervalued because corporations' earnings relative to what we're paying for them are under the historical averages. And I can say I said that because it's all printed up. You can look in your stuff if you've been a client and see that that's what we were talking about. It's not always going to be the case, but it's the best piece of information I can have to say whether a market's under or overvalued. I can't anticipate terrorism or banking collapses or those kinds of things, but in a somewhat normal market, these things hold true over time. And we can look at every different sector to see what its forward PEs are. And as we analyze markets, this was at the beginning of this year. The next 12 months, price earnings and PEG ratios were this. Fiscal year projections, 12 times earnings. That's pretty good. That's way below the averages. It's an undervalued market. We've seen this year, even though a lot of people thought the markets had hit their highs maybe a year ago, well, they've been going up, up, up since then. Mainly as this gets back to 15 times earnings, and these numbers are low relative to the averages. Why don't I have a full head of hair? It's not due to my hereditary problems. I've been an advisor during this period of time. This is a difficult time for investors. I was a genius, an idiot, a genius, an idiot, and a genius. So 3 times I've been a genius in the last 15 years and twice an idiot. So it's very unnerving to deal with a market like that. We call it it used to be the M times. Well, now it's the W or the, I don't know. It's just not a friendly sight, but that is what the markets have done. So if any of you have felt a little jittery about the markets, I understand entirely. Things that I look at, here's a real important thing, the forward PE ratio. Here's the historical average, 16 times earnings. When it's below this line, I expect it to get pulled up to it. This is like a magnet. When it's above the line, like during the dot-com, it gets pulled back down. It kept going because people were, and now it's coming back up. It will always get pulled back to this. So as we analyze the forward price earnings ratios, I'm always going to be looking at some baseline data that's really important. Whether you're looking at a stock, a sector, a country stock market, a global market, this is really important. It will come back to that at some point. Here's the earnings. Everybody thinks that, oh my gosh, the world's, or not everybody, but some people, oh, the world's caving in. I just listened to some conservative talk radio and I bought a bunch of guns and silver and canned foods. But it's the governments that are really having the trouble. I have no debate about that. But corporate profits are at an all-time high. And they've been growing rapidly since that dip there. They're at an all-time high. Corporations are doing great. The fact that the government can't pay its bills does not mean Starbucks is selling less coffee. It could in the future. I'll spend a little bit of time on the global markets. I just kind of talked about how to value stock markets, how the U.S. market looked, and I didn't want to get into too much depth there, but certainly having a methodology to look at the markets, maybe some lights turned on there. I want to talk about the other side of the markets first, the bonds, stocks and bonds. We're in a kind of a new time right now because for many, many years now, investment advisors and certainly the large brokerages have been able to manage risk and volatility in portfolios by just adding bonds. Bonds have been steadily kind of increasing in value mostly over the last 30 years, and they're not generally as volatile as stocks. However, that period of time is kind of changing. We're not going to be able to blindly follow the way that we've invested in the past to manage volatility and risk because of the bond world. What is a bond? A bond is a loan. When you buy a bond, you're loaning somebody money with a promise to pay you back with interest. You buy a government bond, they're borrowing money from you. They're going to pay you back interest along with the principal if they can. You buy a corporate bond, the corporation says, I'll pay you back with interest if they can. The if they can part is default risk. There is a risk to losing all your money in a bond if they default. It's called default risk. But the risk I'm talking about is not default risk. It's interest rate risk. So we generally think, well, you buy a bond, you get interest. That's fine. But generally, when you buy a 20 or 30-year bond, you're not going to hold it that whole time. You may need to sell it at some time. So what I have here is a chart, and I'll just tell you what it says. It's kind of small up here. The hypothetical loss if interest rates go up, if you hold a bond. So let's say that you hold a bond with 10 years to maturity. So you bought a 10-year bond. That's not too long. But you bought it when interest rates were 1.6% on the 10-year. That was a few months ago. And then they go to 2.6. Well, they're already at 2.9, so they did this. A 1% increase in a 10-year bond, you lost 8% of your money. Ooh. What if they go to 3.6? A 2% increase in rates on a 10-year bond, you lost 15% of your money. The longer your bonds have to maturity, the more you can lose. If you have a 20-year bond and rates go up 4%, you'll lose 39% of the value on that bond. Why? Let me tell you why. So you bought a 20-year bond. It was paying 3% when you bought it, and now the rates are 7% for new ones. You're a year into owning this bond and you go, I'm stuck at 3% for the next 19 years. I don't want that. I want one of those new 7% bonds. So I'm going to sell my bond. So, David, you want my bond? I paid $100,000 for it. You're locked in at 4 percentage points below the market for the next 19 years. You want it?
Don't think so.
Don't think so. All right, how about if I sell it to you for $90,000? You want it? No, he doesn't want it. It says here it lost 28%. When I say anything below 72,000, he'd say yes. Because that by buying it at a discount, that'll make up for all the interest he's not going to gain for the next 19 years. You don't lose that money if you hold it to maturity. You just lost $4,000 a year for 19 years. Well, it's the same deal. You lost. Bonds can lose money. That's something. And where are we at on the old interest rate thing? Well, here's from 1958 through 2012, the yield on the 10-year Treasury. They were around 4%. They went to 6. They went to 8 briefly and shot up to 16 almost. They dropped. They did it all over. They kind of settled in here, 6, 4 again. They dropped down to 1.6. Well, actually, this goes through the end of 2012. They actually dropped down to 1.6. I doubt they're going to get below this line, because that would mean you go to the government and you say, I'll give you $101,000 if you'll pay me back $100,000 in 10 years. Okay, that's below that line. That's a negative yielding. It's unlikely to happen. So now we're seeing rates climb back up. They're already to where this dot is. And if we look at the last 50 years, they've never been this low. I kind of doubt that most people in this room think that they're going to continue to be this low or lower. If you think that, buy more bonds. So we have to be very careful about bonds as something in our portfolio. Now, I'm being very generic on bonds. There's all kinds of different types of bonds. But as a big picture, they're not the safe haven they've been for the last 30 years. And this is why I gave you the example. As rates go down, the value of your bonds go up. As rates go up, as I had in this example, the value of your bonds decreases. Because new bonds are better than that piece of junk that you have. So, big topic here. Takes people years to understand this sometimes. So you probably have it in your packet there if you want to refer back. But that's the basics on interest rate movement, bonds. We're not in a default risk environment. We're in an interest rate risk environment right now. This is international equities slide. The only thing I wanted to point out is more of an interesting topic. Of the entire value of the global stocks, the percentage that is U.S. is 46%. So the rest of the world is 54%. And here's that broken out. Europe at 16, UK at 8, emerging markets 13, Japan at 8, Canada at 4, Pacific at 5. It's just kind of an interesting slide. Yet the share of the global gross domestic product is half the emerging markets. The United States is only 19% of the gross domestic product of the world, yet 46% of its stock market value. Just a kind of an interesting slide. This talks about GDP growth of different countries and so forth. Ours is pretty flat. That's not necessarily a terrible thing because that's the top line, that's GDP. Profitability has been climbing as we showed on a prior graph. So you can have the same GDP but have improvements in technology, different things, and actually improve your profit margins where your top line is flat. I'm going to switch gears here a little bit. Another misconception is, where do I get my advice? So a lot of people come to my office a little confused, and we understand why, because we saw the W of the markets. And a common thing might be, well, I went to my stockbroker. He said buy stocks and bonds. Then I went to my insurance agent. He said buy a variable annuity. So I went to my realtor. He said buy a rental house. And then I went to the bank. Their investment people, they said buy a CD. So then I went to my CPA. And the CPA said don't do any of those. And I said, great, what should I do? And he said, I can't tell you, I'm not licensed. I understand the confusion. I mean, if someone has a hammer, the whole world looks like a nail. Whatever they're selling is what they think you ought to be buying. So it's important to start understanding the differences in, kind of follow the money, licensing, those kinds of things. I'm pointing out one. There are two different licenses in the investment advisory arena. One's a broker-dealer, one's a registered investment advisor. And broker-dealer would be Merrill Lynch, Edward Jones, A.G. Edwards, anybody who names a football stadium after themselves, big companies. Football stadium, that'd be kind of cool. Bond Street, no. And so they are held to a different standard legally than a registered investment advisor. They're different licenses. So a broker-dealer will have to disclose basically that they're not required to act in your best interest, and they may put you into investments that are inappropriate to you based upon how they're paid. They're paid on a commission, et cetera, et cetera. So is anybody feeling warm and fuzzy yet? A registered investment advisor, on the other hand, is required to act in the client's best interest by law, and they're held to a fiduciary standard. And they don't receive a commission off the mutual funds they put you into. They'd be waived. So it's really important, but I found this statistic incredible. So they did a survey of brokerage clients. Okay, so you have all your money at XYZ broker. Yep. Do you believe they have your best interests at heart? 77% of them said no. Only 14% said yes. Just thought that was interesting. You have all your money there, you just don't trust them. Right. So what does it mean to be a fiduciary? Well, they have to, one of the problems with a cookie cutter approach that a large firm has, and I understand it, if you've got a firm with 40,000 advisors out there, you can't have 40,000 different strategies going on. you have to dictate what the strategy is. You have to tell them what they're going to put in the portfolios and do it for them. You don't want 40,000 different research things, and one guy comes up with the gold portfolio, and one guy comes up with the world is ending portfolio, and another one with the dot-com portfolio. I mean, the lawsuits would be endless. So they tell them what they're going to have, and so when somebody comes in and they tell me where they're at, I generally know what they're in already without looking at the statement. It's kind of a cookie cutter approach. And so, not always, but very often. And so as a fiduciary, they have to understand the client, make full disclosures, be confidential, various things that you would expect a fiduciary to do so they can actually put together a financial plan that has you in mind instead of just the big cookie cutter approach. Switching gears again. So I just kind of wanted to talk a little bit about that just so you kind of got a feel of asking, if you have assets somewhere, just knowing that you feel comfortable with the motivation of the people making decisions in your life. Sometimes it's a good time to review it. What is an annuity? Most people hate annuities, especially you. And I think annuity being a dirty word, I want to define it a little bit. Feel free to hate them after I talk, but I want to differentiate between different kinds, because saying the word annuity is like saying, I'm in the market. Okay, you're in stocks, bonds, gold, commodities. What? I don't know, I'm in the market. Well, that doesn't tell me anything. I own a car. Well, you own a Yugo and you own a Ferrari. Those are not the same thing. Yeah, they're both car. Well, it's the same thing with annuities. There's all kinds of different annuities. The actual term of annuity is a series of payments for your lifetime, like a pension. Most annuities have nothing to do with that. Some annuities are volatile assets in the stock market. Some act like a CD. Some act like a totally different class of asset that can't go down in a given year. There's all different kinds of annuities. The problem, the reason most people hate annuities is because of the variable annuity. The variable annuity is the biggest selling, most oversold annuity and has ridiculous fees. So there are good, bad, and indifferent annuities. So we're going to talk about some of those. There's something called, the basic of all annuities is an immediate annuity. Sometimes these are used in Medicaid planning, where the assets are transferred to one of the spouses. An immediate annuity is purchased, and all that means is for as long as they live, they're going to get a payment every month. So that might be used in that kind of situation. An immediate annuity is similar to Social Security or a pension. They'll pay you as long as you live. There are single premium deferred annuities. That's where maybe someone a little bit younger says, well, I want to be, maybe you're 50 or 60. I want to have an income for life that I can't outlive, but I don't need it now. So you can invest in these now, knowing they'll grow over time, and they will promise you a lifetime payment no matter how long you live. Someone might do that because they want cash flow. Maybe they don't have enough cash flow. They don't have a pension anymore. Most people don't have pensions anymore. They have 401ks. So they kind of have to, it's like buying your own pension, but better. It's better because, let's say you have a pension at Boeing and you and your wife go take a trip, plane goes down, your heirs get nothing. In these, there's an investment account. They would still get that. So it's a little bit better. They take away market risk. It doesn't matter what the stock market does. So that's a good part about annuities. They take away market risk. It doesn't matter what the stock market does. They take away longevity risk. It doesn't matter how long you live, they have to pay you. There's fixed annuities. They're like a CD. Very similar to a CD, they just pay a little bit higher rate. Instead of getting it at the bank, you're getting it at the insurance company. The bank insures it to a certain amount, the insurance company insures it to $500,000. Fixed indexed annuity, we're going to spend a little bit more time on this. Probably something most of you have not heard about. Broker dealers don't talk about them because they talk about variable annuities. A variable annuity is an investment in the stock market with an insurance wrapper around it. That's the most sold product. I'll never sell one. The problem with the variable annuity, as I see it, is that the average variable annuity has 3.4% annual fees. Okay, well, 3.4%. Well, let's own one for 15 years. And let's do 3.4% compounded for 15 years. I think I'm right around 50% or more. So all I have to do is have the stock market that it's invested in go up more than 50% to break even. Woo! That's just the numbers. I'm a numbers guy. It doesn't make a lot of sense to me. They do give you your original investment back. So if the market went down during that 15 years, you'll at least get your original investment back. Most people, that's where they're sitting. Original investment back. No gains. Fixed index annuity, we'll talk about that in the next class too a little more. They're an interesting variation. They will give you the stock market returns, but with a floor and a ceiling. The ceiling right now on the 7-year ones is 6%. The floor is 0. So let's say that we had a stock market that was volatile. It was up 20, down 20, up 10, down 10, up 5, down 5. Right back where it started, essentially. Well, with this indexed annuity, you'd have a 6% in the up because the first year, because it went up more than 6, it has a ceiling. The second year, you'd have a 0. The third year, you'd have a 6. The fourth year, you'd have a 0. The fifth year, I said it was a 5% return, you'd have a 5 because it's in between 0 and 6. 2 6s and a 5 in a flat, volatile market. You can't go down. They're a very important part of conservative investing right now. Again, I'll never use the variable annuity, but this particular one, that's the basic example of how they work. So in the last 15 years, an interesting stat, and I'll ask everybody, in the last 10 years, how many years has the stock market been up and how many downs? So I asked, how many down years in the last 10? Anybody want to guess? 3? Any other guesses? It's 1. Only 2008. 2004 through 2012, or 2003 through 2012, 9 up years. But that one down year was a doozy. Biggest ever. And the 3 years, the 11th year back, 12th year back, and 13th year back were down years. So in the last 15 years, we've had 11 up years. It's been that up and down thing. With the variable annuity, you didn't make anything. With the fixed annuity, you made a little bit. With the fixed index annuity, you had a whole bunch of max years and 4 zeros. So your rate of return would be exceptional. They're exceptional in a volatile market. A year like 2008 actually helps it. Because, yeah, you didn't make any money in a big crash. You didn't lose any. And it usually takes years to recover. And you go, I get all the years of recovery as positives, one at a time, and I took nothing in that big down. So there, again, a very important strategy that we can use. And I would say maybe even instead of an overweight to the bonds, which we identified as an issue that can go down. This cannot. So when we can quantify our risk. I put in your handouts just a basic, I call them equity indexed annuities here, fixed index annuities, same thing. Just a basic discussion about them in layman's terms. Again, we're doing years worth of study here today, so. But it's something you can refer to. And I want to talk about quantifying risk, because there's too many just terms thrown out there. Are you aggressive or moderate or conservative? Are you it's like, I don't know, I suppose I'm aggressive when the market's up, but when it's down, I want to be conservative. That's generally what I hear. So I think it's important that we quantify risk, and what I mean by that is I think people overestimate their risk tolerance in an up market. They want to be all in. When it goes down, the hurt of the down market is way more than the thrill of the up market, especially when you're in your retirement years. And we'll talk about, I got some great slides in the next class that will go over that. But what I sometimes do is I like to quantify how much someone could lose in a down market so they can better understand what their risk truly is. So let's take an example of a person that came in and said, all right, I want 5% in cash, 45% in stocks and bonds, real basic example, 25% in one of those things that pays me a monthly check for as long as we live, and 25% in one of those things that can only go up and can't go down. What happens if the stock market drops 35%? 08 happens again. It's possible. I hope it doesn't happen. It's possible. The loss on the income for life is zero. They take away market risk. They made a promise to pay. The loss on the fixed index annuity, zero. Loss on the cash, zero. Usually, when the stock market goes way down, the bond markets don't. They're not correlated. They don't move together because people are selling their stock and they're going to safety, and their safety they think is bonds. That's what happened in 08. That's what happens in most markets. So let's assume that the bond half, this moderate portfolio, let's say was half bonds and half stocks. The bond half didn't go down. So 22.5%, which is half of 45, of your portfolio was in the stock market that dropped 35%. Multiply those two numbers together. The potential loss was 7.8 or 8% roughly. So that's kind of your risk. So if we have a repeat of the worst year ever in the stock market, your portfolio in this situation would be down 8%. Can you live with that? It's a way to quantify. What if it was up 35%? Well, this wouldn't go up. This would, but not as much. It has moderate returns. This, cash isn't yielding anything. The stock market part of this would go up, and the bond market probably flat. So you'd have gains in roughly half of your portfolio. So only gains, and your overall gain would be in the double digits in that situation. So that can be, again, a way to monetize the risk that you're taking. This doesn't include real estate, pensions, other assets, Social Security, other things. I'm not done yet. So when we do asset allocation related to this, there is a whole lot more than just stocks and bonds. There are alternatives, oil and gas, commodities, small cap, mid cap, large cap, emerging markets, developed markets, U.S., foreign. There's various methodologies that one can use when analyzing. And one of the things that we look at is correlation. I mentioned when the stock market's up, the bond market generally has a negative correlation. It might go down, and vice versa. Stock market's down, people are buying bonds, it would go up. And so we have to kind of put these together, piece them together in a way that we can limit or reduce risk. Another interesting risk reduction strategy would be a variation of the indexed annuity. I talked about how you could have the 0 to 6% every year. There's another version that, depending on your age, you can do these, that give you a stock and bond mix. It's a blended index. You get whatever it does every year, uncapped, minus 1.5%. So if it's up 3%, you get 1.5. If it's up 13, you get 11.5. If it's down 13, you don't count that year. So it's a way to be in a blended stock and bond market mix with no downside risk in a given year. And we never put all our money into any strategy. And I've seen that. Let me give you that example. Another little diversification piece. Bob doesn't like the word diversification back here, Bob Shane, but you'll appreciate this example. I had an attorney call me. She had a client in her 80s. She wanted me to talk to her about investing. So I went to her and I talked about mixing things up, diversifying. And she just looked at me and says, I don't want any of your risky stock and bond market. Okay, but actually you're kind of taking a lot of risk right now. She goes, no, I'm a conservative investor and I'm not going to invest in that kind of stuff. And so we had a long talk, and I couldn't get her to budge. And so she was worth $2.5 million. And 3 months later, her $2.5 million worth of Washington Mutual was completely worthless. She had nothing left. She didn't want to invest in my risky stock market. And I explained to her, you are not only in the stock market, you're in the riskiest of all stock markets. You're in one stock. Another example, guy came in, he says, I'm already diversified. I don't need to listen to you. It was 99. And I said, well, you're diversified. What are you in? He says, well, I'm in Microsoft, Apple, Dell, Intel, and IBM, and Cisco. They're all in the same industry. They're just components of the same thing. And I didn't get through to him either, you know, and so he obviously had a little struggle there afterwards. So there's, you know, if you really strongly believe in investing in something, a lot of my clients have a lot of real estate or something that they really understand. I said, yeah, that's where you need to be because you understand that. And it's okay not to diversify. You know, my investments are in companies and people and that kind of thing. That's okay. That's what I'm doing right now. There'll come a time, though, where I'm going to want a big series of different diversified assets and cash flows. And certainly as we do a financial plan for someone, it's just critical that we analyze those kinds of things. But, you know, and I catch myself talking about investments. The first thing, though, that I talk about with clients and people in your life as you maybe guide them, because I know everybody is asked by maybe the younger generation, what should I do? Before we ever talk about anything like this, we're talking about their debt. We're talking about other things. I remember a person came in, I have $250,000, I want to invest it, I want it to be safe, and I want to invest it with you. So I asked him some questions. I said, how would you like a 6.5% guaranteed rate of return investment on that $250,000? I said, I'm in there. What's that? And I said, your mortgage, pay it off. Because it was a 6.5% rate. I said, I can guarantee that 6.5% saved is 6.5% earned. It's the same thing. I can guarantee you were going to pay 6.5%. So by paying that off, you no longer have to pay that. I can't get you 6.5% guaranteed with no risk. Pay off your debt. And they were like, that was easy. Why didn't we think of that, you know? But these are kind of last, you know, you got to take care of all the other things first. And if you have debt, you know, it's real easy for me as a financial advisor to pick off the stuff that you're paying on. It's the same as earnings. It just has a negative sign around it. I have credit card debt. Where should I invest my money? 17%? I mean, come on. Where do you think they should invest their money, everyone? I'd say invest it in that credit card, and, you know. And not to say that debt's evil. I mean, I buy CPA firms, and they're leveraged. But that's a leverage into an asset as opposed to leveraging into my shoes and my coat. These don't have a very good resale value. I can assure you of that. So when you're thinking about your finances, understand there's a lot more to it than just mix of assets. But I think it's really important that we point out that there are other things more important. As I started this class, I talked about the mission statement for everybody, talked about what's really important. As I end the class for today, another part of what's really important is getting your affairs in order, maybe helping the next generation get their affairs in order. If somebody's coming to me that's 25 years old, I do not have the same advice for somebody that's 65. 25 is like, do not invest in my stuff. Get yourself a house. Get out of debt, student loans, credit cards, leverage. Buy a rental house if that's your thing, if you know how to fix them or whatever. Something, invest in your business or your education. A whole different plan than somebody 65 and they're coming to me, should we buy some rental houses? I'm like, you know, maybe after 20 years you paid that debt down, the rents are going up, but I don't think you want to repair a toilet when you're 85, you know. I don't know that that's a real good plan for that person. So investments have a life cycle. There's different times you should do different things in your life. This is more of the kind of the retirement type of approach. You know, once you've made your money, you don't want to lose it. If you're not going to earn it anymore in your lifetime, you have a different approach than you would maybe at my age or somebody younger. So there is no cookie cutter approach to this kind of stuff. And a lot of it just depends on you as an individual. I know that there's people in this room that I'm aware of that are very aggressive in their investments, and they're doing an incredible job with that, and that's who they are. And there's other people not so much, and certainly even couples. Sometimes, you know, I got the guy that likes to play the stock market and his wife that wants to take away his computer.